The global economy in 2025 is a turbulent sea, roiled by the aggressive trade policies of the United States under President Donald Trump's second administration. His sweeping tariffs, targeting not only adversaries like China and Russia but also long-standing allies like the United Kingdom, Canada, and the European Union, have sent shockwaves through international markets. The question on everyone's mind is whether this is a calculated trade war aimed at reshaping global commerce or a high-stakes power play to influence stock markets and domestic political narratives. To understand the chaos, the motivations, and the far-reaching consequences, let's embark on a narrative journey through the origins, impacts, and global reactions to Trump's tariff policies, weaving together economic analysis, historical context, and the voices of those affected. The opening salvo: Tariffs as a political and economic weapon. It was January 2025, and the ink was barely dry on President Trump's second inauguration speech when he issued an executive order signaling a dramatic shift in U.S. trade policy. The order, invoking the International Emergency Economic Powers Act, IEEPA, declared foreign trade practices a national emergency, threatening U.S. economic security. The stated goal: to address the large and persistent U.S. goods trade deficit, which reached $1.2 trillion in 2024, and to reshore American manufacturing. The mechanism: a barrage of tariffs, starting with a baseline 10% levy on all imports and escalating to country-specific rates as high as 145% for China. Steel and aluminum tariffs, a hallmark of Trump's first term, were resurrected and doubled to 50% by June 4, 2025, while auto imports faced a 25% tax starting April 2. Copper, pharmaceuticals, and semiconductors were also targeted, with investigations into other sectors underway. This wasn't Trump's first rodeo with tariffs. During his first term, 2017 to 2021, he imposed tariffs on steel, 25%, and aluminum, 10%, sparking retaliatory measures from trading partners and raising prices for American consumers. The 2018 trade war with China, which subjected 60% of U.S.-China trade to 20% tariffs, was widely criticized as a failure, with U.S. consumers bearing much of the cost. By December 2021, hot-rolled band steel cost $1,855 per metric ton in the U.S., compared to $646 in China and $1,031 in Europe. Yet, Trump doubled down in his second term, arguing that low tariffs had left the U.S. vulnerable, allowing cheap imports to shutter factories and deepen reliance on foreign supply chains. The narrative Trump spun was seductive to his base. Made in America wasn't just a slogan but a national security imperative. He framed tariffs as a tool to revive manufacturing, create jobs, and reduce the trade deficit by forcing companies to relocate production to the U.S. His rhetoric was steeped in populist imagery. American workers crafting beautiful American-made cars, appliances, and other goods. But beneath the rhetoric lay a complex reality. Was this truly about economic revitalization, or was it a gambit to flex U.S. muscle on the global stage, unsettle markets, and dominate headlines? The economic earthquake: immediate impacts on global trade. The tariffs rollout was chaotic, marked by sudden announcements, reversals, and social media ultimatums that left trading partners scrambling. By April 2025, the average U.S. tariff rate had soared from 2.5% to 27%, the highest in over a century, before settling at 15.8% by June after some rollbacks. Tariffs became a significant revenue source, contributing 5% of federal income by July, up from a historical 2%. The immediate effects were seismic. Consumer prices and supply chain disruptions. American consumers felt the pinch almost immediately. Economists estimated that the tariffs amounted to an average tax increase of $1,200 per U.S. household in 2025, with some projections suggesting a lifetime loss of $22,000 to $58,000 for middle-income families. Imported goods, from Chinese electronics to Mexican avocados, became pricier. Retail giants like Adidas and Mattel warned of price hikes, while U.S. manufacturers using imported components, such as automakers, faced higher costs that rippled through supply chains. The auto industry, a cornerstone of US's Mexico-Canada trade under the USMCA, was particularly hard hit. Tariffs on auto imports, effective April 2, 2025, increased costs for vehicles and parts, which often cross borders multiple times during production. Mexico, which sends 80% of its exports to the U.S., faced a potential 16% GDP slash if the 25% tariffs persisted. Supply chain delays and tighter customs checks at U.S. borders exacerbated shortages, driving up freight costs and complicating production timelines. Market volatility and global recession fears. Global financial markets reeled. On April 3, 2025, the S&P 500 plummeted nearly 5%, its worst day since June 2020, wiping out $5 trillion in value over 2 days. Oil prices tanked, with Brent crude falling 6% amid fears of reduced global demand. The International Monetary Fund, IMF, and the Organization for Economic Cooperation and Development, OECD, downgraded 2025 global growth forecasts, with the WTO predicting a 0.2% decline in global goods trade, driven by a 10% drop in North America. J.P. Morgan raised its global recession probability to 60%, up from 40%, citing material headwinds from the tariffs. The U.S. dollar, typically a safe haven, weakened, reflecting investor uncertainty. Asian markets, particularly in Japan, saw banking shares plummet, with Prime Minister Shigeru Ishiba calling the tariffs a national crisis. In Europe, the EU braced for a 30% tariff on its goods starting August 1, prompting Ursula von der Leyen to pledge continued negotiations while preparing retaliatory measures. Retaliatory measures and trade war escalation. Retaliation was swift. China, hit with a 145% tariff by May 2025, imposed 34% levies on U.S. goods and restricted rare earth exports critical for high-tech industries. Canada, facing 25% tariffs on non-USMCA goods, retaliated with 25% duties on $155 billion of U.S. exports, targeting agriculture and manufacturing. Mexico, similarly targeted, promised countermeasures, while the EU suspended investment in the U.S. and drew up plans to hit back. The tit-for-tat escalation evoked memories of the Smoot-Hawley Tariff Act of 1930, which deepened the Great Depression. Unlike 1930, however, the U.S. was now the sole instigator, with the world's retaliation focused squarely on American exporters. U.S. farmers, already stung by China's tariffs on soybeans and pork, faced further losses as global markets sought non-American alternatives. The strategic play, tariff as leverage or chaos. Trump's tariff strategy was as much about geopolitics as economics. His administration tied tariffs to non-trade issues, such as immigration and drug trafficking. For instance, tariffs on Canada and Mexico were justified as pressure to curb fentanyl smuggling and illegal migration, while China faced additional levies for its role in the fentanyl supply chain. This blending of trade and foreign policy objectives confused allies and adversaries alike, with blunt social media posts and last-minute reversals, like the 90-day tariff pause for most countries, except China, on April 9, adding to the chaos. The reciprocal tariff gambit. Central to Trump's approach was the concept of reciprocal tariffs, designed to match the tax rates other countries impose on U.S. goods. For example, the EU faced a 20% tariff, Japan 24%, and South Korea 26%, reflecting their respective trade barriers. The administration argued this would level the playing field, but critics, including Harvard's Robert Lawrence, pointed out that tariffs often hurt U.S. consumers more than foreign producers, who could lower prices to offset the levies. Moreover, the focus on goods trade ignored the U.S.'s significant surplus in services trade, skewing the narrative of American victimhood. Peter Navarro, a staunch tariff advocate, framed the policy as a response to a rigged global system, dismissing negotiations in favor of permanent trade barriers. Yet, other advisers, like Treasury Secretary Scott Bessent, suggested tariffs were a negotiating tactic to extract concessions. The 90-day pause, Besant claimed, rewarded countries that refrained from retaliation, giving the U.S. leverage in trade talks. The reality was messier. Only the UK and Vietnam secured tentative trade deals by July, while China's tariff war escalated, and the EU and others prepared to retaliate. The stock market angle, power play or miscalculation. Some analysts speculated that Trump's tariffs were a deliberate stock market power play. The initial announcements triggered massive sell-offs, followed by rallies when tariffs were paused, suggesting a pattern of market manipulation. The April 9 reversal, which spared most countries but ramped up pressure on China, sent global stocks soaring, erasing some of the prior week's losses. Critics argued Trump was using market volatility to project strength, betting that short-term disruptions would force trading partners to the negotiating table. However, the strategy risked backfiring. Business confidence plummeted, with 84% of U.S. business leaders expressing concern about the tariffs' impact on the economy's global standing. Investment slowed, and consumer spending weakened as prices rose. Goldman Sachs, while lowering its recession probability from 65% to 45% after the April pause, warned that the remaining 10% baseline tariff could still increase overall rates by 15%. The Penn-Wharton budget model projected an 8% GDP reduction and a 7% wage drop, far worse than a comparable corporate tax hike. The global response, redrawing the trade map. As the U.S. unleashed its tariff storm, the world began to adapt. The European Union, under Ursula von der Leyen, sought to forge a new global trading nexus, deepening ties with Canada, India, South Africa, and Asia-Pacific nations like Japan and Vietnam. Proposals emerged for a trading bloc excluding both the U.S. and China, aiming to stabilize global commerce amid American unpredictability. China, despite its 145% tariff burden, pivoted to other markets, increasing trade with the EU, Mexico, and Vietnam. Its yuan's 30% depreciation since April softened the blow, keeping its exports competitive. Meanwhile, Canada and Mexico, heavily reliant on U.S. trade, faced economic contraction, with Mexico's industrial states particularly vulnerable. The World Trade Organization, WTO, already weakened by U.S. obstructionism since 2019, faced further paralysis when the U.S. suspended its budget contributions in March 2025. Multiple countries filed WTO disputes, but without a functioning appellate body, resolutions were impossible. In the U.S., federal courts challenged Trump's IEEPA authority, arguing it overstepped congressional powers, though an appeals court allowed the tariffs to persist pending litigation. Voices from the ground, the human cost. Beyond the macroeconomic numbers, the tariffs reshaped lives. In Detroit, auto worker Maria Gonzalez worried about her job as production costs rose. "We're supposed to be making cars here, but the parts are more expensive now. How's that helping us?" she asked. In Iowa, farmer Tom Reynolds faced dwindling markets for his soybeans, hit by Chinese retaliatory tariffs. "We're collateral damage in this trade war," he said. In Shanghai, factory owner Li Wei adapted by redirecting exports to Europe, but not without pain. "The US was our biggest market. Now we're scrambling, and margins are thinner," he said. In London, small business owner Sarah Patel braced for higher prices on imported goods. "Everything from electronics to clothes is going up. My customers can't afford this," she lamented. The historical echoes, lessons from Smoot-Hawley. The parallels to the Smoot-Hawley Tariff Act of 1930 are striking. Signed by President Herbert Hoover, Smoot-Hawley raised U.S. tariffs to record levels, triggering global retaliation and deepening the Great Depression. Trump's tariffs, often higher than Smoot-Hawley's, risk a similar spiral, with the U.S. as the primary target of global ire. Unlike 1930, when tariff wars were multilateral, today's retaliation is laser-focused on the U.S., threatening its exporters and global economic influence. The critic's case, economic folly or nationalist triumph? Critics, including economists and international leaders, argue that Trump's tariffs are a self-inflicted wound. The Penn-Wharton budget model estimates a $5.2 trillion revenue boost over a decade, but at the cost of significant economic contraction. Robert Lawrence of Harvard Kennedy School highlights the regressive nature of tariffs, which hit low-income households hardest, and their limited impact on manufacturing jobs, which employ only 8% of U.S. workers. The Center for American Progress calls the policy a major economic and strategic blunder, isolating the U.S. and incentivizing firms to move production to countries with weaker labor protections. Supporters, including Navarro and Vice President J.D. Vance, counter that tariffs are a long overdue correction to decades of unfair trade practices. They argue that short-term pain is necessary to rebuild U.S. manufacturing and reduce reliance on foreign supply chains, particularly for critical goods like semiconductors and pharmaceuticals. The revenue, they claim, could fund tax cuts, though critics note this contradicts the goal of reducing the federal deficit. The geopolitical ripple effects. The tariffs have strained U.S. alliances. Canada's Justin Trudeau called them very dumb, while Mexico's Claudia Sheinbaum vowed to protect her country's interests. The EU, Japan, and South Korea, key U.S. military allies, face tariffs that undermine strategic partnerships, particularly as they counter China's regional influence. Trump's apparent warming toward Russia, juxtaposed with his trade war against Canada, has baffled observers, with Trudeau noting the contradiction of appeasing Vladimir Putin while attacking allies. The tariffs also risk accelerating a global trade realignment. As the U.S. retreats into protectionism, the EU and others are forging new partnerships, potentially marginalizing American influence. China's ability to redirect trade flows underscores its resilience, while the U.S. risks becoming a less attractive market for global firms. The future, trade war, power play, or both. Is Trump's tariff policy a trade war, a stock market power play, or a blend of both? The evidence suggests a mix of ideological commitment and tactical opportunism. The trade war is real, with tangible economic costs and global retaliation. Yet, the erratic rollout, announcing steep tariffs, then pausing them, hints at a strategy to maximize leverage and market impact. Trump's history of backing off threats, as seen in the April 9 pause, suggests he may use tariffs as a negotiating chip, but his persistence with China, 145% tariffs by July, indicates a willingness to escalate against key rivals. The stock market angle is less clear. While volatility benefits certain investors and reinforces Trump's image as a disruptor, the broader economic damage, higher prices, reduced growth, and strained alliances, undermines the narrative of a controlled power play. The Penn-Wharton model's dire projections and the WTO's forecast of shrinking global trade underscore the risks of miscalculation. Conclusion. A high-stakes gamble. Trump's tariffs have reshaped global trade, for better or worse. They've sparked a trade war that threatens economic stability, strained alliances, and redrawn trade maps. Whether driven by a vision of American resurgence or a desire to dominate global markets, the policy's costs are undeniable: higher prices, market volatility, and a potential recession. Yet, for Trump supporters, the tariffs are a bold stand against decades of perceived trade injustices, a gamble that short-term pain will yield long-term gain. As the world navigates this new reality, businesses, consumers, and governments must adapt to a fractured trade landscape. The EU's pivot to new alliances, China's resilience, and the US's isolation signal a shift that may outlast Trump's presidency. For now, the global economy holds its breath, waiting to see whether this is a masterstroke or a catastrophic misstep.